Hey everyone, welcome back to the channel. Today we're diving deep into something that every trader new or seasoned has to face: losing money. It's a painful but powerful teacher. In fact, some of the most profound lessons in trading are learned not from our wins but from our losses. So we're going to explore 20 trading rules that the market only seems to teach you after you've taken a hit. These are the lessons that cost money to learn, but once you understand them, they become your armor. Let's start with the Oracle himself, Warren Buffett. His first two rules are legendary. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, this sounds impossible, right? How can you trade and never lose? The real wisdom here isn't about avoiding every single losing trade. It's about prioritizing capital preservation above all else. Before you even think about how much you can make, you must obsessively think about how much you could lose. Losing money is a part of the game, but losing your entire capital is not. This rule is your foundational mindset: defense first, offense second. This brings us to our second rule, from the brilliant Victor Sperandio. Successful trading comes from emotional discipline, not intelligence. You can be the smartest person in the room, with a PhD in finance and a perfect trading model. But if you panic when the market moves against you, you're going to lose. Fear and greed are the two puppet masters of the market. Fear makes you sell at the bottom, and greed makes you buy at the top. Emotional discipline is the strength to stick to your plan, to stay calm under pressure, and to make rational decisions when everyone else is losing their minds. It's a skill you build, trade by trade, loss by loss. Now, let's talk about a classic mistake. Rule 3 comes from William Eckhart. Losing traders tend to average down on losing positions. This one hurts because it feels so right at the time. You buy a stock, it goes down, and you think, great, it's on sale. I'll buy more to lower my average cost. But what you're really doing is throwing good money after bad. You're increasing your risk on a trade that's already proving you wrong. Instead of admitting a small mistake, you're doubling down and turning it into a potentially catastrophic one. Successful traders add to their winning positions, not their losing ones. This leads perfectly into Rule 4, cornerstone of risk management from George Soros. It's not whether you rewrite or wrong, but how much you make when you rewrite and how much you lose when you re-wrong. This is the concept of asymmetry. You can be wrong more often than you're right and still be incredibly profitable. Imagine you make 10 trades. You lose on 7 of them, losing 1% of your capital each time. That's a 7% loss. But on the 3 trades you win, you make 10% each. That's a 30% gain. Your net profit is 23%, even though you were only right 30% of the time. It's all about the size of your wins versus the size of your losses. So how do you control those losses? Rule 5 from the great Tudor Jones is simple and powerful. Trade small and protect your capital first. When you're starting out, or even when you're experienced and trying a new strategy, your position size is your number one risk control. Trading small keeps your emotions in check. A small loss is just a data point. A huge loss is an emotional gut punch that leads to bad decisions. By trading small, you give yourself room to be wrong without blowing up your account. You stay in the game long enough to learn. Staying in the game is about patience. Warren Buffett gives us Rule 6. The stock market is a device for transferring money from the impatient to the patient. The market preys on impatience. Impatient traders jump into trades without a plan, chase hot stocks, and can't stand to wait for a setup. They get bored and want action. Patient traders, on the other hand, wait. They wait for their specific setup, for the perfect entry point, for the market to come to them. And once they're in a trade, they have the patience to let their profits grow. They understand that wealth isn't built overnight. Which brings us to one of the most famous trading adages ever, Rule 7, from Richard Dennis of the Turtle Traders fame. Cut losses short and let profits run. It's so simple, yet so hard to execute. Our human nature is wired the opposite way. When a trade is losing, we hold on, hoping it will turn around. We feel the pain of a realized loss. When a trade is winning, we get scared of giving back the profits, so we cash out too early. You have to reverse this instinct. Be ruthless in cutting your losses and incredibly patient in letting your winners grow. A single great trade can pay for a dozen small losses. Tudor Jones hammers this point home again with Rule 8. Don't focus on making money. Focus on protecting capital. Notice a theme here? The greatest traders are obsessed with risk management. They see themselves not as profit seekers, but as capital protectors. If you protect your capital, the profits will eventually take care of themselves. Your primary job is to manage downside. Every trade should start with the question, where will I get out if I'm wrong? Not how much can I make? The market is also constantly changing, which is why Rule 9 is so critical. It's a trading adaptation of Charles Darwin. It is not the strongest traders who survive, but those who adapt best to the market. A strategy that worked perfectly last year might be useless this year. A bull market requires a different approach than a bear market. You must be a student of the market, always learning, always observing, and willing to change your approach when the evidence tells you to. Rigidity is the enemy of longevity in trading, but you don't need to be a perfect predictor. Rule 10 from legendary trader Mark Cook is reassuring. You don't have to be right all the time, just be right enough. This ties back to Soros's rule. Stop striving for perfection. You will have losing trades. You will miss opportunities. You will make mistakes. That's all part of the business. The goal isn't to be a perfect trader. It's to be a profitable trader over the long run. Focus on your process and your risk management, and the results will follow. And process is everything. Linda Rashek's Rule 11 is the mantra of all disciplined traders. Plan your trade and trade your plan. Before you ever click the buy button, you need to know your entry point, your exit point for a loss, your stop loss, and your target for a profit. This plan is your roadmap, created when you are calm and rational. When you're in the trade and emotions are running high, your only job is to execute that plan. Don't second guess it. If you need to make changes, do it after the trade is closed, during your review, but a plan is useless without opportunity. Rule 12 is from Buffett again. Big opportunities don't come often. When they do, act properly. In trading, long periods of boredom are punctuated by moments of intense opportunity. The patient trader conserves their capital and mental energy during the quiet times. Then, when a high probability, low-risk setup appears, the fat pitch, as Buffett calls it, they are ready to act decisively. This doesn't mean being reckless, but it does mean having the conviction to take the trade your plan has been waiting for. To spot those opportunities, you need to follow Rule 13 from Stan Weinstein. Trade what you see and not what you think. This is a huge one. We all have biases, opinions, and hopes about where the market should go. Yeah, but the market doesn't care what you think. Your opinion is worthless. The only thing that matters is the price action. Is the trend up or down? Is the price above or below key support? The charts tell a story. Your job is to read the story, not to write it, and sometimes that story makes no sense. John Maynard Keynes gave us Rule 14, a humbling reality check. Markets can remain irrational longer than you can remain solvent. You might be 100% correct in your analysis that a stock is overvalued. But if the market decides to keep pushing it higher, you will lose all your money shorting it long before you're proven right. Never fight a strong trend just because you think it's irrational. The market's reality is the only reality that pays. This humility is a professional trait. Rule 15 is another gem from Tudor Jones. Every day I assume I might be wrong. This mindset keeps you sharp. It forces you to constantly reevaluate your positions and to honor your stop losses. Arrogance is a trader's worst enemy. The moment you think you've figured it all out is the moment the market is about to teach you a very expensive lesson. Stay humble. Stay paranoid. We're circling back to psychology now. Rule 16, often attributed to Buffett's thinking. It's clear. The most important quality of a trader is psychology, not intelligence. We've seen this theme before, but it bears repeating. Trading is a mental game. It's a battle with yourself, with your own fear and greed. You can teach someone a technical strategy in an afternoon, but it can take a lifetime to master the psychological discipline to execute it consistently. But you also need confidence. Rule 17 from the legendary Jesse Livermore says, I always knew I would be rich. I never doubted it for a moment. This isn't arrogance. It's a deep, unshakable self-belief in your ability to succeed in the long run. It's the confidence that allows you to take the next trade after a series of losses, knowing that your system has a positive expectancy. It's the belief that keeps you studying and improving day after day. And to reinforce the point one more time, Victor Sperandio gives us Rule 18. Trading doesn't require a high IQ, only emotional control. This should be liberating for so many people. You don't need to be a genius to succeed. You just need to be disciplined. You need to be able to follow your rules, manage your risk, and control your emotions. It's a game of discipline, not brain power. So how do you balance all this? Rule 19 from Ray Dalio offers a beautiful synthesis. A great trader must be both flexible and disciplined. This sounds like a contradiction, but it's not. You need the discipline to follow your trading plan religiously. But you also need the flexibility to recognize when the market conditions have changed and your plan is no longer valid. Discipline and execution, flexibility and strategy. That's the sweet spot. Finally, we arrive at Rule 20, the ultimate truth for any trader. From Seykota, to succeed in trading, you must be willing to accept being wrong. Every single trade you take is a hypothesis. Sometimes your hypothesis will be correct, and sometimes it will be wrong. Being wrong is not a personal failure. It's a business expense. You have to embrace it, learn from it, and move on to the next trade without an emotional scar. The traders who can't accept being wrong are the ones who blow up their accounts. So there you have it. 20 rules forged in the fire of real-world losses. These aren't just clever quotes. They're a roadmap to survival and success in the markets. Keep them close, review them often, and let them guide you on your trading journey. Thanks so much for watching. If these lessons resonated with you, hit that like button and subscribe for more content to help you become a smarter, more disciplined trader. See you in the next video.